In this week's video, we'll review the latest charts to help us answer the question, is the next stop for the S&P 4,300? For the most part, the charts speak for themselves this week, thus we'll be moving very, very quickly. Feel free to use the pause button on your video player. Stock market did not handle the inflation data that was released on Wednesday morning very well. There were serious declines and hard data points during Wednesday's session that brought increasing concerns, including many of those shown on your screen. The Consumer Price Index was released on Wednesday. Thursday brought the Producer Price Index, or PPI. Like CPI, it came in well above expectations. The data was released at 8:30 on Thursday morning. While the inflation news on Thursday morning was very, very similar to what we saw on Wednesday morning, the final result in the market on Thursday was much, much better. The S&P 500 finished up 49 points, and if you were just looking at price action, it was really constructive during the entire session. There were still some things to be concerned about at the close, but much, much better than what we saw on Wednesday. Typically, when a market is able to shrug off bad data, that tends to lean bullish. It's also fair to ask, what else was different? What was known on Wednesday relative to what was known on Thursday? Both days saw worse than expected readings on inflation, but the outcomes were significantly different. I think you can make an argument that the news about the CDC's change on mask recommendations is extremely significant in terms of sending a signal to the general public that things are moving back toward what we had before the pandemic. This is a headline that appeared in the print edition of Friday's Wall Street Journal, and the improvement that we saw during Thursday's session carried into Friday's session. Intraday, advancing volume was 88% of total volume on the NYSE, and very similar numbers intraday on the NASDAQ. Why is that relevant? It tends to tell us during the day what institutions are doing. They tend to control volume. Nothing magical about any of this. All of it, from a concerning perspective, a mixed perspective, and a positive perspective, all of it is simply part of the weight of the evidence. The market dealt with negative inflation data much, much better on Thursday. And on Friday, retail sales came in below expectations, import prices and export prices above expectations. And once again, the market was able to shrug it off. That tends to lean bullish. At the open on Friday, we were able to clear this area of potential resistance where my cursor is. And the concept that we were in, or remained in, a what type of stocks do we want to own market relative to a market where market participants are asking, do I even want to own stocks? Typically, buy and sell decisions are driven by these three major topics. Opportunity cost, is there a better place for my capital? Money management, did I have a 20% gain? Am I going to let some of it slip to a loss? And then the third tier would be, I'm concerned about the general market. I'm concerned about stocks in general, and thus I want to lighten up. These are different decisions based on different sets of hard data. The charts on this page and on the two pages that follow speak to opportunity cost. Growth was a leader relative to the equal weight market. That's been shifting. This type of look tends to cause a shift in our allocations over time. The same thing can be said for XLY relative to the S&P 500 and QQQ relative to VTV. Similar shifts over time here. XLK Tech relative to dividend payers, rolling over time. Small caps relative to financials. This is February of this year where a lot of these shifts started to take place. Very, very similar concepts here. Semiconductors. This is a lower high relative to this high. This is a lower low relative to this low. And this is semiconductors relative to the equal weight S&P 500. Similar situation here. Bitcoin relative to the S&P 500 makes a high in February. It has not made a relative high since then. Another chart that reversed in February. Emerging markets, SCHE, relative to value stocks. None of these charts tell us that SCHE, GBTC, SMH, or any of the symbols that appeared on the two previous charts doesn't say they're dogs or they can't make money. We just have hard evidence in hand that says from a probability perspective, our capital may be better off elsewhere. Citigroup Economic Surprise Index helps us keep an open mind about worse than expected outcomes in the coming weeks and months or a topping process. You can see there's a big change in economic surprises relative to this point here and where we are as of May 13th. The National Financial Conditions Index basically flat week over week. No significant change in credit conditions. That, for the most part, would be a positive. You can pause your video player here. This would tend to lean negative. This is from Ned Davis Research. It's basically saying when inflation relative to a look-back period hits a certain point, a point that we've hit in the present day, stocks tend to struggle. Equal weight S&P 500 relative to healthcare. Indecisiveness here. If we zoom into that area, it's a good visual of the asset class battle that's been taking place in recent weeks and months. Sometimes this type of battle can be frustrating, but if you stick with it and continue to monitor the hard data, eventually you end up in the right place. NASDAQ Composite relative to the S&P 500. This chart speaks for itself. We're below this level here, here, and here. This is as of Thursday's close. Triple Qs relative to long-term treasuries. This is a weekly. This is momentum rolling over. Just look at the trend of the triple Qs relative to SPY. This is a little bit of a read here at the stay-at-home trade. In favor, not so much in favor lately. Similar situation, this is monthly growth, VUG, growth stocks relative to the S&P 500, momentum slowing significantly. It's a weekly look of growth stocks relative to SPY, similar rollover type message. It doesn't necessarily mean IWF or VUG can't make money. It speaks to probabilities related to relative performance. Similar situation here, monthly growth stocks relative to value stocks. This is monthly momentum here, similar message in price. None of this predicts the future. These are the charts that we have in front of us today. ARK Innovation ETF relative to TLT. Topping look here doesn't necessarily mean it's topped. That's why we have the expression failed breakdown since February 12th. Something to keep an open mind about worse than expected outcomes in the stock market looking out several weeks or several months. Consumer staples beating bonds, triple Qs, NARKK. Another opportunity cost look here. Your allocations to FDN would tend to be higher here and decreasing in here relative to RSP. It's a chart we added on Thursday evening. Why? This is data as of Thursday's close. NASDAQ stocks greater than their 20-day exponential moving average. This is the S&P 500 on the bottom here. This is basically saying at this level here, you need to make a stand soon, as in during Friday's session, which is exactly what happened. Because if you don't, really bad things can happen in the stock market. If you don't, really bad things can continue to happen. Nothing binary here, but you can see the market held here, here, and here as far as the breadth indicator goes, and the S&P 500 made a stand. This is as of Thursday's close, so as you can imagine, on Wednesday evening, after Wednesday's close, we had a very vulnerable look here. Thus far, we've bounced. I'm guessing this chart's going to look even better. As of Friday's close, we don't have that data in hand yet. Everything that we just said about the last chart applies to this chart. This is also still concerning that we're below the pink trend line. You can make an argument that would be similar to this point here and this point here. NYSE advanced decline line earlier in the week broke the shorter term trend line. Friday, we popped back above this blue line. If you're a client, the decisions that we've made in recent weeks, for the most part, have all been opportunity cost and money management decisions. This week, I'd estimate that about 70% of the changes that we made were based on A and B, and maybe 25 to 30% being concerned about some of the things that we're seeing in the general market. As of Wednesday's close here, relatively easy to envision a possible break below this trend line. The evidence we have in hand didn't happen. This S&P 500 chart here is as of Thursday's close. There's nothing particularly alarming here, maybe a little bit concerning. If we move to Friday's close, it helps us with three major scenarios that it's always prudent to keep in mind, and you plan around these scenarios. It's possible the market's going to go and make a new high up into this area up here. It's also possible we never came down and tagged this blue trend line where my cursor is, and we never filled this gap here where my cursor is. So it's possible that from this gap here, which could act as resistance where we closed on Friday, we may come down and have some form of a retest here that would give you a chance to make some more asset allocation or cash redeployment decisions if that happens. And the third scenario would be that we don't have one, we don't have two, we come down into this area here. The moves that we made this week take all three scenarios into account. It's very, very easy to look at Friday's session or maybe Thursday's and Friday's session in isolation and think everything is fine. That's not necessarily the case from a probability perspective. This is the look of the NYSE Composite weekly chart at the end of the week. This is hesitation here, somewhat of a doji form. You can see at a low, this is hesitation, and we get a reversal. Here, hesitation, similar look, we get a reversal this way. It's possible that this is a hesitation and we could still get a reversal this way, hence taking somewhat of a measured approach where we're respecting all three scenarios. Similar situation here, some good. We made a new high, SPY-TLT here at the end of the week. It's about 10 minutes before the close. And this momentum look is good here on this part, but it's relatively weak to the upside as well. Somewhat of a hesitation look here, similar to this hesitation look here. We don't need to predict this, or this. If we have a game plan for all three of those scenarios, how would we handle this, and this? This is as of Thursday's close, S&P 500 relative to gold. This is somewhat of your keep an open mind about lower lows or a retest scenario. Airlines, which speaks to the reopening trade relative to the S&P 500, sitting here at potential resistance as of Thursday's close. The ratio was up 2.66% during Friday's session, and this has somewhat of an encouraging look here, similar to this look here, or maybe this look in here. Doesn't really matter whether you look at this chart as of Thursday's or Friday's close. This is somewhat of a hesitation look here in the credit markets until it's cleared. We're respecting it. This is a Bitcoin trust relative to long-term treasuries. It peaked in 2017 here, had a bullish breakout recently, and right now it looks like a failed bullish breakout, making a new low this week as of Thursday's close. This is Bitcoin trust relative to bonds. Very, very similar situation here. Bitcoin trust relative to the S&P 500. Breakout now, somewhat of a failed breakout look relative to this. High yield, somewhat having a hesitation look. Is this consolidation before we move higher? Or is this a yellow flag for the general market? That's to be determined. Somewhat of a mixed bag here. Leisure and entertainment. bullish breakout, somewhat of a failed breakout look. Good news, it improved a little bit on Friday, up 1.74%. This is Thursday. This would be the bad news. The good news is, as of Thursday, we were right at the 61.8% retracement of the A to B move from the November low to the February/March high. Talked about this before, high beta, low volatility, somewhat of a concerning look here in Q1 of 2020. A similar look here, this is as of Thursday's close. We did get a little bit of a pop on Friday, up 2.5%, but the jury is still out on this and we'll keep an open mind. This is one of our opportunity cost charts, mid-caps relative to equal weight. Leadership has deteriorated over the past several weeks or months, making a new low as of Thursday's close. Similar situation here for small caps running into potential resistance. It's possible we'll move out here, but we need to see some improvement. How about foreign stocks relative to the S&P 500? This chart has some work to do. This is still in a downtrend. We have a little bit of a base here. From a bullish perspective, like to see this ratio get up here. That may happen, but it hasn't happened yet. Opportunity cost, emerging markets relative to the S&P 500. Look pretty solid here in February, but now we're below the 61.8% retracement of this A to B move. Like many charts, this chart may turn, but it has work to do. Longer term version has somewhat of a failed breakout look at the moment. And foreign developed markets, EFA relative to SPY, has some work to do here. This is still in a long-term downtrend. Crude oil relative to the S&P 500 trying to perk up a little bit. Gold relative to the S&P 500, bullish breakout, failed breakout, has a lot of work to do. Possible this is somewhat of a double bottom look, but once again, a lot of prove it to me ahead. A lot of relative charts in flux. This would be one of them. Home builders, very, very good things could happen if we can get out here, or may look like this. On a relative basis, it may be disappointing. This is Friday's session, 10 a.m. roughly. This is your broadening trade, equal weight relative to the S&P 500 above the trend line, trying to get above the moving average, very, very similar to this look here in 2009. Technical analysis, human behavior is about subtle differences. This is a different look here relative to all of this in here. Whether it holds or not remains to be seen. Pretty easy to see. This is a very long-term downtrend in energy relative to the S&P 500. This could be your left shoulder, this could be your right shoulder, and this could be your neckline. Inverse head and shoulders pattern speaks to bottoming and reversal probabilities. Tech sector relative to the S&P 500 monthly momentum. Psychologically, tactically, and strategically, think it makes sense to be open to all three scenarios. New highs, a retest of this low down here around 40.48, or even new lows. Very, very difficult to get caught off guard if you're ready for all three scenarios, tactically, strategically, and maybe most importantly, emotionally. It's a daily DeMark chart of the S&P 500 after the close on Friday. DeMark charts and indicators are proprietary tools from Market Studies, LLC. Red diamonds here, potential support we held. S&P futures broke below this similar support line, but then rallied. We're still near this gap right here, potential resistance, but our upside magnets or probabilistic targets for 3 trading sessions have been sitting at 43.28. No need to predict anything here. We trade the chart in front of us next week and in the subsequent weeks, making no assumptions about what's going to happen Monday or over the next 5 trading sessions. You do that by taking it day by day, pushing our ego aside and having a short memory. Yesterday's decisions are yesterday's decisions. We wake up today and we make the best decisions that we can with the charts and data in front of us. Rinse and repeat. And we all know the only way that any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.